Hi all. So today we're going to get into part five, the real economy in the long run. And this is sort of the exciting section because we're going to get into the real meat and potatoes of the macroeconomy. And to understand this, we're going to have to go through a couple of sections. So chapter 13 is an introduction to the financial system of the United States. This is the group that matches money between savers and borrowers. And then the next section, we're going to talk about insurance and risk, how the financial system accounts for this and tries to build in risk and account for it in its future pricing. So basically, this is a way of considering how we project prices into the future. And then our final chapter, we're going to look at unemployment, and we're going to be looking at how we measure unemployment and its significance in the economy as a whole. But with that, we're going to jump right into chapter 13, saving, investment, and the financial system. So, what is the financial system? The financial system is the group of institutions in the economy that help match one person's savings with another person's investments. So, they are the groups that facilitate the borrowing of money from individual savers. So instead of us having to go to people we know and ask for loans, we instead can go to these institutions which provide the savings of individuals as loans to other people in need of them. So financial markets, these are where the financial institutions through which savers can directly provide funds to borrowers. So the financial markets are these marketplaces in which these financial institutions operate. We have two key examples. We have the bond market and the stock market. The bond market is the market for bonds. So pretty self-explanatory, right? And this is a certificate of indebtedness. A bond is a certificate of indebtedness. And what we mean by that is that a bond is basically a piece of paper that is a almost guarantee of a loan. So you buy the bond at a value, and the contract says that this bond will be worth a certain amount of money by the end of its lifespan. And the cash you pay for the bond initially, that down payment is basically the debt that the payment that the bond issuer is taking the loan on. So this is sort of a specific way of structuring a loan in which it's not really a loan, so to speak, but it is a issued piece of paper which receives interest payments and payments until it reaches its face value. This is a form of debt finance. A firm issues debt to raise funds, but it's not just limited to businesses, it's also government and local municipalities. While in contrast, the stock market is what we call an equity market. And the reason we call it an equity market is that a stock is a claim to partial ownership in a firm. And this means it's equity finance. And equity largely refers to how much of the country is, or how much of the company is owned by the individual owners. So equity is the cash in the firm that is obligated to the owners. And the stock market is where you trade these slips of shares basically that are your percentage obligation to own the finance, or the percentage obligation that the company owes to you of profits when it decides to issue things like dividends. Financial intermediaries, meanwhile, are financial institutions through which savers can directly provide funds to borrowers. These are things like banks, which we are probably the most familiar with, right? You have your cash deposited in a bank. When you deposit the cash into the bank saves that cash, and not just for you to spend, but also to create loans for others. The other institution here is mutual funds, and these are institutions that sell shares to the public and use the proceeds to buy a portfolio of stocks and bonds. So instead of you going and buying individually shares in each different firm, a mutual fund diversifies and buys these shares for you, and all you have to do is buy shares in the mutual fund. So it's basically a single source of buying a lot of different stocks. Typically, it has a higher buy-in, usually a few thousand. Now, what does this mean for going back to something we were talking about with GDP? Well, really, savings and investment play a crucial role in national income accounts. And what we mean by them playing a crucial role in national income accounts is, let's revisit for a moment what we meant when we talked about GDP. GDP, right, is this equation, y equals c plus I plus g plus nx. Now, what does this mean? It means GDP, that equals y, equals consumption, equals, which is the c, plus investment, which is the I, plus government spending, which is the g, plus net exports, which is the nx. Well, To show the importance of investment, we can do a short little trick here, and we assume that we're operating in a closed economy, and a closed economy means there's no trade. So we can remove the net exports. Why? Because if there's no trade, net exports has to equal 0. Solving for I yields the following then. So if we have solve for I, so basically if we write out an x, we say this is, if we mark out an x, right, what we're saying here is this is 0. So we're left with y equals c plus I plus g. If we solved for I, we would get I equals y minus c minus g, which I is our investment, also equals our national savings. So savings equals y minus c minus g. Now, first off, you might be like, wait, what are we getting at? What's the intuition here? And it's like, it actually makes a lot of sense here. If y is our GDP, this also basically means it's our national income. This is all the money we make. Consumption, right? This is the money we spend on goods. And then G, this is the money we spend on taxes. So the entire country, its income, minus how much it spends on consumption, minus how much it spends on taxes, then yeah, that equals savings. That equals our savings rate. Note, national savings, this is the total income in the economy that remains after paying for consumption and government purchases. So again, just kind of reframing exactly what this equation is telling us. If we introduce taxes, we further refine this equation so that we get something like this. National savings then equals GDP minus taxes minus consumption. Okay, this makes sense. This is private, right? This is our private income, Y, the taxes we pay to the government, T, minus our private consumption, C, plus T minus G. Now, what's this T minus G telling us? Well, taxes, right, are the government's revenue. So taxes minus government revenue or government spending, that has to equal the public savings. So we have two different breakdowns here. The Y minus T minus C tells us the private savings, meaning the income that households have left after paying taxes and consumption. And T minus G equals public savings, meaning the tax revenue that the government has left after spending for its spending, or after paying for its spending. Now, to analyze this government budget, we have a couple of options. We can first off look at the budgets. Basically, this is our government budget. We have a budget surplus when we have an excess of tax revenue over government spending. And in this case, our public savings have to be T minus G is greater than 0. So if public savings are greater than 0, that means we're running a budget surplus. Meanwhile, if we're running a budget deficit, that means a shortfall of tax revenue over government spending. That means our taxes minus our government leads to a negative number. We're spending more than we're saving. And so if T minus G equals 0, then that's a balanced budget. But one note for budget deficits that I think is important, you'll hear this a lot in politics about reducing the deficit. Note that the deficit, if it's negative, that simply means that we're adding more debt, period. That doesn't mean the debt's going down. Running a deficit means the debt is increasing. So by reducing the deficit, all we're saying is that we're reducing the rate at which our debt is growing, not actually reducing debt. Now, the meaning of saving investment. Investment simply means purchasing new capital. Investment means buying, borrowing, and spending it on capital that will allow you to create new products, create value, etc., for purchase and sale. That's the role of investment. Saving, meanwhile, however, is storing funds to either grow or be utilized later. This means purchasing stocks, bonds, or savings in bank accounts all contribute to this. Now, one note that I think is important here, you might say you're investing when you're buying stock in a firm, or you might say you're investing when you buy a bond. In reality, economists call this saving, and the reason why is you are putting that cash aside to access in the future. You are saving that money to be spent in the future, whether it's your retirement, whether it's to make a large purchase, etc. That's saving. Investment in economics specifically refers to buying physical material goods in order to, or services in order to turn around and create new goods. Now, this savings and investment work and function in the same way that everything else in this course does. It goes to a market. And so what the market we are particularly interested in for savings investment is the market for loanable funds. And this is the market in which those who want to save supply funds and those who want to borrow invest and borrow to invest demand funds. Note, interest rates serve as the price, and the supply amount, the total amount of funds equals the quantity, and supply is created by savings and demand created by investment. Now, what this looks like is something like this. The market for loanable funds is then this supply, which this is the savings, and the demand is those seeking to invest. Now, one thing I want you to note here is the interest rate is the price, like we mentioned, and the loanable funds, the total supply of, or the total quantity of funds. Now, why does supply go up as interest rate goes up? Well, this actually is pretty intuitive, right? If you put your cash in a savings account and you get very low interest rate, like currently today, you're not really incentivized to leave your cash in a savings account. However, if that savings account yields 5% interest rate, that's a huge incentive for people to save. It makes it worthwhile to put cash in the market. However, if you're borrowing the higher the interest rate, right, that means it's more expensive to purchase items. And so since it's more expensive to purchase items, individuals are less enthused about doing so. And so demand decrease or quantity demanded decreases as the interest rate goes up. Meanwhile, quantity demand increases and the quantity of loanable funds in the market would increase as the interest rate the quantity demanded of loanable funds would increase as the interest rate declines. So equilibrium is the interest rate in which the quantity supplied of loanable funds balances with the quantity demanded of loanable funds. Now, there's policy incentive or there's policies we can use to manipulate and influence the amount of supply in the market for loanable funds and the demand in the market for loanable funds. For example, policy one is a savings incentive. This increases the supply and it creates the same constant supply. We shift our supply curve rightward. By shifting our supply curve rightward, it now intersects the demand curve at a lower interest rate and a higher equilibrium quantity funds supplied. Now, how do we do this? We do this through things like tax incentives. So, for example, many salaried, if your firm offers retirement, it typically offers a 401k. The government allows you to save on taxes by putting your cash pre-tax into a investment account. And so it actually makes sense for you to put more money in your investment account because you get to delay taxing on that and let it grow and then receive paid taxes when you withdraw it later. So it makes sense to save more money. And that's an incentive that saves you money also from taxes by saving more money. And that's an incentive that encourages people to increase supply. But we can also have investment incentives, and there's things like investment tax credits. So investment tax credits typically are things like deductions for purchasing for their investment. It could be for firms, for example, it could be the wages they pay. It could be purchases they make in manufacturing or machinery, et cetera. Those are all investment tax credits. These shift the demand for investments rightward, right? Because it becomes cheaper for you to purchase these items because you get a offset with taxes. And this results in higher interest rates and more loanable funds. And you can see exactly over here that the shift in demand created by income tax or investment tax credits leads to exactly what you'd expect. So demand shifts rightward. And when demand shifts rightward, what we find is we have a new equilibrium interest rate that is higher than the original interest rate and a new equilibrium quantity, which is also higher than it was originally. Now, there's another thing the government can do that influences the market for loanable funds, and this is its deficits and surpluses. So think about for a moment when the government runs a deficit, what it's doing, right, is it is spending more money than it's taken in. In order to raise those additional funds, it has to turn around and borrow money from the private market. So when the government borrows money from the private market, what it's doing is it's taking cash away from the market for loanable funds so it can use it itself. Ultimately, what that means is the government contracts the supply of loanable funds when it is running a deficit. Simultaneously, means that if we have a surplus, that means we are adding that money into the net market for loanable funds because the government now has extra on hand to loan out. And what we call this process, though, of when the government what we call this process when the government runs a deficit and takes loans out of the private market is we call it the crowding out effect. And one of the reasons we call it the crowding out effect is think about it like this. If you've ever watched basketball, you have these big guys called post. And the guy who's playing post, his job is to, when the ball bounces off the net and doesn't go in, his job is to rebound the ball. And we call it boxing out. And what we mean is he puts himself in the way of everyone else in the ball and catches the ball. In a way, the government is the biggest player in the economy. And the crowding out effect is kind of a symbol that they get to lay claim to debts and loans first to borrow. And so they get to take that money from the private sector, leaving a smaller amount of money for those outside of it. Now, that covers everything for government budget deficits and surpluses. Now, one graph I want to leave us with, though, is our graphic of the US federal debt. And I want to point out something interesting to you, this phenomenon. Notice that we have a consistent history where debt spikes during wars. So Revolutionary War was a high debt point, debt was paid off, and then the Civil War meant a high debt point, and then the debt was gradually paid off. And then World War I hits and high debt and paid somewhat off. And then all of a sudden debt skyrockets here, and then it further skyrockets during World War II. So the question you might be wondering is what happened here and what happened in 1930? Well, this is the Great Depression. And long story short, during the Great Depression, the US explored this philosophy of trying to spend its way out of the recession. And the basic logic was this. Think about your equation for GDP. It's Y equals C plus I plus G plus NX, right? In a depression, what happens is the C goes down, the I goes down, and the NX goes down. And so a guy by the name of John Maynard Keynes basically thought of conceptually, if those three go down, then what if I just increase the government spending to offset the decreases in consumption and invest in net exports? And so that's what happens in the 30s is we have a huge increase of the government trying to spend its way out, and then World War II breaks out, which leads to even higher spending than ever. And then we have a reduction in the debt until the 80s. And in the 80s, Reagan decides to re-engage kind of the Cold War and try to outspend the Soviets in a military buildup, which actually proves successful. But it does lead to higher debt and then a need to reverse the debt. And then when the financial crisis of 07 and 08 hit, what did the United States and other European countries do? They bumped back to the 1930s and the logic of the 1930s and since increased debt to try to spend their way out. Now, what's the conclusion here? The conclusion is really largely that financial markets are crucial for a healthy economy and function much as a market does. Importantly, they link the future and present through negotiated access to finances. And what do we mean by the future and the present? Well, interest is payments to access your future income. And it's the return for saving your money to delay an access at a future point. But how do we think about this? How do we come up with this? What's the idea that goes into present value, future value, and linking? Well, that's what we're going to get into next chapter when we talk about the basic tools of finance. All right, thank y'all. See you next.